Everyone on Wall Street is sprinting for the exits right now. Every major outlet covering retail in 2026 is using some version of the same phrase: dead money, value trap, structurally impaired. And while that consensus has been building for months, I have been doing something that looks, on paper, completely insane. I have been quietly buying the most hated retail names in the entire market. Not a small position, not a speculative nibble. A real, deliberate allocation into the exact sector everyone is telling you to abandon. Give me 8 minutes, because the disconnect I found between what the headlines say and what the actual balance sheets show is something every dividend investor needs to see before this window closes. Let me start with the narrative itself, because the narrative is doing a lot of work that the actual data does not support. The story everyone has accepted as fact goes something like this: e-commerce has permanently and irreversibly won. Physical retail is a dying relic, and any company still operating brick-and-mortar stores at scale is simply running out the clock on a business model that consumer behavior has already abandoned. That story is clean. It is simple. It fits neatly into a headline. And it has been repeated so many times across so many platforms that most investors now treat it as established fact, rather than as the contested thesis it actually is. Here is the problem with accepting a narrative simply because it has been repeated enough times to feel true. Repetition is not evidence. And when I actually went looking for the consumer spending data underneath this story, rather than the headline summarizing it, what I found did not match the apocalypse framing at all. Consumer spending data through the first half of 2026 shows something the dead retail narrative conveniently ignores: a genuine resurgence in high-touch, experience-driven physical retail. Not across every category, not uniformly, but in specific identifiable segments where the in-person experience itself is the product. Categories where touch, fit, immediate gratification, and human interaction are not inefficiencies to be optimized away by e-commerce. They are the actual value proposition that online channels structurally cannot replicate. This is the distinction the doom and gloom coverage almost never makes. It treats retail as a single, undifferentiated category, losing uniformly to e-commerce. But the spending data tells a much more specific story. Certain physical retail formats are not just surviving the e-commerce transition, they are capturing renewed foot traffic, precisely because consumers, after years of pure digital convenience, are demonstrating real and measurable demand for the physical experience. Now here is where this becomes directly relevant to dividend growth specifically, rather than just a contrarian retail thesis in isolation. When an entire sector gets priced by the market as a structurally declining business, the share price compresses far more aggressively than the actual underlying cash flow does. That gap between sentiment-driven price compression and the reality of the cash flow still being generated is exactly where dividend growth investors are supposed to be hunting. A company trading at a depressed valuation because the market has priced in permanent decline, while its actual free cash flow generation remains intact, is a company with enormous capacity to grow its dividend from a payout ratio that has substantial room to expand. This is the mechanism most momentum-following investors completely miss. They are pricing the narrative. I am pricing the balance sheet. And when those two things diverge as significantly as they currently have in parts of the retail sector, that divergence does not last forever. Either the narrative eventually catches up to the cash flow reality, which means a meaningful re-rating of the share price upward, or the cash flow keeps compounding regardless of what the narrative does, which means the dividend itself keeps growing while you are being paid to wait for the market to notice. Let me be specific about what I mean by deep value hiding in ignored blue-chip companies, because this is not about buying any retail name simply because it is currently unpopular. Unpopularity alone is not a thesis. What I am specifically screening for is companies with established blue-chip balance sheet quality, meaning real free cash flow generation, manageable debt obligations, and a demonstrated multi-decade history of returning capital to shareholders that have been swept up in the sector-wide pessimism, despite individual fundamentals that do not actually match the doom narrative. Sector-level sentiment gets applied as a blanket discount across every name within that sector, regardless of whether each individual company's specific fundamentals actually justify that discount. The market is, in this specific moment, treating retail as a monolith. It is not pricing the difference between companies, and a company whose specific format, customer relationship, and operational execution are actually benefiting from the high-touch resurgence. This is exactly the kind of mispricing that rewards patience and a willingness to look past social media consensus. And I want to be direct about something here. The social media consensus on retail right now is loud, confident, and almost performatively certain. That certainty itself should make you pause. Markets rarely reward being part of a confident, unanimous crowd. The crowd being confidently wrong about an entire sector is precisely the environment where genuine dividend growth opportunities get created, because the price has already absorbed pessimism that the actual cash flow trajectory does not support. What this means practically for a dividend growth portfolio is this. You are not buying these names for a high current yield. You are buying them because the payout ratio has substantial room to expand from a depressed starting valuation, because the underlying free cash flow is more durable than the narrative suggests, and because a re-rating back toward fundamentals produces a total return profile that popular sectors simply cannot match. I am not telling you retail as a whole is suddenly the best sector in the market. I am telling you that treating an entire sector as uniformly dead is exactly the kind of crowd behavior that creates specific opportunities, the specific individual opportunities I have been quietly accumulating over the past several weeks. I am putting together the full breakdown of the specific names that pass this screen, the ones where the balance sheet quality and growth align. That is coming next, but before that video goes up, I want to know where you actually stand on this.